This week, BHP launched what could be one of the biggest deals in mining in decades. This year, gold has hit several all-time highs and copper is up 17%. So how sweet is it? I'm with Michael Gentile. He is co-founder of Bastion Asset Management. Michael, welcome back to Kitco.
Great to see you, Michael.
Michael, we just have to start with M&A. This week, we learned that BHP is attempting to acquire Anglo American in a deal size estimated at $39 billion. That follows a series of other huge mining deals. I can't name them all, Michael, but Osino Resources and Yintai for $368 million, Alamos Gold and Argonaut for $325 million. What's driving all this M&A, and can it continue, Michael?
I think it absolutely will continue, Michael. I think a bunch of things are driving it. First of all, the scarcity of projects that are shovel-ready, that are able to be built in quality jurisdictions are at record low. It's been a dramatic underinvestment in mining and development the last 10 to 15 years. So there's the cupboard's bare, so to speak. There's not a lot of projects that are ready to be built. You've also seen the projects that have been built, most of them have gone wildly over budget. So the cost to build these projects are increasing by the month, by the year. And so it's a lot cheaper to buy projects that are either almost completely built, or in the case of BHP, buy producing assets that are already in construction. It's a much cheaper bet, especially with how cheap the stocks are trading. You can buy producing assets or near development producing assets, at maybe 30, 40% of the cost of building a new one today. So that's why you're seeing all these shovel-ready projects or projects that are half completed that are already in production getting snapped off the board, both in the copper space and the gold space. You listed a few of them, Michael. There's been many, many more, especially in jurisdictions which are more favorable to operate in. You're seeing those projects get snapped up extremely quickly in the market as we speak.
What's the impact we're seeing on the junior sector, Michael?
That's interesting, so the stocks remain incredibly cheap. I mean, we've had a huge move in the gold price, a nice move in the copper price. The stock remains very, very cheap. So that's also another impetus for M&A. If the stock market doesn't want to pay for these projects, the corporates that are now cash flowing significant amount of free cash flow with clean balance sheets now have latitude to get more aggressive. And like I said, if you can buy something that's already built or 90% built for 40 cents on the dollar, why would you put your cash flow on the ground and look for new projects? So I think you're going to see that value gap between the developers and junior precious metal producers and the seniors start to narrow as more and more M&A happens. Less projects create scarcity, creates premium pricing, and then hopefully the stock market, the retail institutional investors wake up and see the value in the development and exploration space as well. So I think that this M&A should lead to increasing valuations in the space. I expect to see more of it, and as more and more investors benefit from these takeouts, and other stocks that have yet to get taken out should start trading at higher valuations in the market.
Michael, how do you contrast the precious metal space with the critical mineral space? Do you have a particular favorite?
I've been for years saying how positively decline I am to the precious metal space. Been very nice to see the gold price finally break out here to new all-time highs. I mean, there's two separate themes that are driving H1, Michael. In my opinion, gold is reasserting itself as a world currency again, as the US dollar and US treasuries fall more and more out of favor for multiple reasons, which you can discuss later on if you like. The large countries that hold 65% of their FX reserves in US dollars are slowly and now quickly rotating out of US dollars into gold as a currency. So that's one thematic that I think is going to continue and should have a nice tailwind for many years ahead for gold prices and the gold equities eventually as they catch up to the gold price. On the EV side, it's a different story. It's a demand-driven side with the transition towards electric vehicles and more electrification of the grid. We need more of these basic EV metals, and there's a huge scarcity of quality projects to build. So we don't have enough copper to meet the demand that we're going to need for this EV transition. And so therefore, we need a higher stimulus price to incentivize companies to build new lines, incentivize increased production. So on the copper EV metal side, it's demand-driven. On the precious metal side, I think it's a fundamental rotation of US dollar reserve currency into a more stable currency, which is gold. And so both have very positive tailwinds at their backs. I have a slight preference for gold because it's less dependent on macroeconomic environments. So in a slowing economy or in a recessionary scenario, gold would do very well, whereas copper is more sensitive to the economy. So if you're a bear in the economy or have some macroeconomic concerns going forward, copper can be affected, but the driver of electrification will be an excellent tailwind for copper in the decades ahead.
Now, Michael, speaking with critical minerals, we have seen a bit of cautionary tale with what's happened with the nickel markets. Obviously, nickel was part of the critical mineral space, key ingredient in EVs. But what we have seen is we've seen that despite having support by governments for critical mineral policies, we've seen a series of closures of nickel mines in Australia. just because they haven't been able to compete with the build out that has been happening in Southeast Asia. I'm just wondering, we do see government support, we do see government mandated policies for supporting critical minerals, but also at the same time, what type of concern or what type of lesson should we take what's happening in nickel?
Yeah, I think investors, I mean, there's two ingredients that lead to a positive backdrop for any commodity, Michael, right? It's supply and demand. So, I think a lot of investors got kind of lithium, same thing. Lithium is even more dramatic in terms of the correction we've seen, right? So when you have strong demand for a commodity, does not necessarily mean that commodity is going to go up in a straight line forever. You also look at what's the available supply, so in the nickel, you mentioned Indonesia, Southeast Asia, there was an abundance of supply and they're currently flooding the markets with it. So despite having a positive, demand backdrop for nickel, the nickel prices suffer. Despite having a very positive demand backdrop for lithium prices crashed 90% from the highs because supply started to respond to the high prices. Demand was a little bit slower than people were anticipating a couple of years ago, and the price had a severe price correction. So in order for a commodity to systematically work, you need both, restricted supply and inability to bring on new supply in a relatively short manner. I was skeptical on lithium, Michael, last couple of years because lithium is not in short supply. Geographically or geologically speaking, there's abundance of lithium globally. So high prices would stimulate a strong response. If you look at copper, we've been mining copper for 60, 70, 80, 100 of years. The high quality copper deposits globally, most of them have been mined out. So the deposits you're moving towards today in copper are ever lower grade, ever more expensive to bring onto production, and ever lower quality, which means higher cost per pound to bring into production. So that means you need a stronger uplifting price for a very long time to incentivize new production. So when investors are looking at any commodity, you got to say, yeah, prices might go up because of demand, but what will the supplier response be? How quick will the supplier response be? What impact will that have on pricing going forward? So every commodity has its own story to tell, but you can't just get excited about demand without looking at the supply side.
Kind of a lesson within the metal space and commodity space is liquid is absolutely beaten up. Now, in another interview, and then tying on for what you're talking about, you said that lithium and nickel look interesting, as well as zinc, although I should note that zinc has had a bit of a lift in the last month.
Yeah, anytime a commodity, Michael, gets to a price where producers are forced to shut off production, so you get that point in the cost curve where the higher cost producers are now losing money on a per pound basis to produce the commodity, that gets my attention as a commodity investor. So I've started to look at lithium names again. I'm not a wild-eyed lithium bull. I'm not saying lithium prices are going to dramatically reassert themselves to the upside, but lithium prices have now got to a level where some of that high-cost production that came out when the lithium price spiked is starting to come off. You're starting to see the same thing happening in nickel as well. So zinc is at a price now where you're far from incentive pricing. You have pricing that's probably barely making money for most producers. So in that sense, those prices are more likely to go up than down in the months and years ahead. And that's usually a good place to start as an investor. Now I've got to get comfortable with the demand, and I've got to get comfortable with how much supply would come back on if prices move back up. That's the other key thing you look at when you're investing in commodities. It's nice that production is coming back offline because prices have fallen. But if prices are back up 10, 20%, does that production come right back online and causing more problems in the future? So yeah, when the prices drop a little enough where producers start to feel the pain or producers start to shut in production, that's usually a good place to start. And if you're positive on the demand outlook, that's probably a constructive starting point to do some work on a commodity in particular.
In another interview, you're critical of big pension funds not investing in resource stocks, one of Canada's top sectors. Why should pension funds invest more in mining, Michael?
Look, I'm not a fan of top-down edicts. I think pension funds should be allowed to invest where they see the highest returns. I think what I said in the interview was a lot of those pension funds have lost the skill set of investing in the resource sector. That they may have 30 analysts covering the technology sector and maybe one 28-year-old kid covering the commodity sector. They may have let go of most of their experienced commodity investors over time. So I think the capacity of a lot of pension funds to invest in the resource sector has been dramatically reduced. So whether they want to or not, their ability, their skill set in their organizations has been dramatically hollowed out, like the industry has as well. Like 10 years of underinvestment, Michael, it's not only in the mining industry, it's been in the investment community as well. We don't look at these stocks. I would strongly encourage them to look at the sector as a capitalist myself, because I think the returns on these stocks are going to be phenomenal in the next 3 to 10 years. I mean, the valuations where these stocks are trading at, the free cash flow yields these companies are going to generate far outpace anything I see in the market today, yet they're not paying any attention at all, right? So I think they'll get there eventually, but the time to invest is now when the valuations are at rock bottom levels, but a lot of organizations don't have the teams in place to do that right now, which is a problem for the industry. We've got to start hiring people that know how to invest in mining stocks and in the sector in general if we're going to allocate capital as a world company, a world community to this sector.
Now, Michael, help us out with what's happening in Quebec. You're probably Canada's most important or one of the most important regions for mining. You're an Eastern Canada specialist. You're based in Montreal. What are some of the top, how would you say, top developments or that you're looking for that's going to be happening in Quebec? I mean, there's a massive amount of investment, and there's also a number of juniors that are exploring out in that area.
Absolutely. I mean, I think we mentioned earlier at the beginning, if you Michael, you've seen the shovel-ready projects in Canada, whether it be, Valentine Lake acquired by Marathon, you saw Argonaut Gold, any project in Canada that is kind of shovel-ready or in construction is getting taken out. Why is that happening? Is because a lot of the other jurisdictions that have been very positive jurisdictions for mining, and quite honestly, getting a little more difficult these days. Latin America, we saw First Quantum in Panama, we've seen, Mexico get a little more difficult, some issues in Africa as well. So the jurisdictional premium associated with high quality jurisdictions like Quebec continues to increase in the market. What Quebec has done that not many other provinces have done is they put in place a very supportive framework for mining, both in terms of tax support, encouraging the mining industry, especially in the critical metal sector, vertical integration. So if you're a major mining company going, where do I want to focus the next 20, 30 years of my company's cash flow in terms of building the next mine, Quebec screens very, very well. They have an abundance of resources, great infrastructure, roads, power, workforce, experience in the mining space, supportive government, tax programs. So it's a very attractive place to set down your flag and build mines. I think what you're going to see, Michael, as all these developers get taken out, the next stage will be the resource development companies. And if you want to start acquiring, major resource packages in a jurisdiction over a 15, 20-year view, I think Quebec positions itself very well to be a premier place to build mines in the future, both on an environmentally responsible basis and an economic basis.
Michael, I want to finish with top macro trends that you're watching for in the space. So we have seen that we're expecting there to be some more rate cuts from the Fed, but that looks like that's being deferred just because inflation has not come down as quickly as it's wanted to. You mentioned at the top talking about debt levels and how that can advantage gold, liking it a little bit better. Again, what are some of the top macro trends that you're looking for and how that could actually play upon metals, Michael?
Yeah, in the precious metal space in particular, Michael, I think there's a major paradigm shift we're going through right now. If you go back on YouTube, dig up some of my old interviews from 2018, 2019, I was talking about when rates were zero, how the U.S. government's going to be trapped. Even though they were funding their debt with 0% interest rates back then, and there wasn't a balance sheet problem in terms of interest rate problem back then, I said if rates ever go to 5%, the U.S. government is going to be in significant financial difficulty. Lo and behold, rates are knocking on the door of 5% again today. The U.S. is running, $1 trillion deficits in real time, $1.5 trillion to $1.7 trillion deficits if you annualize that 5% interest rate on their debt. I think the gold market, the bond market, and the global investment community are figuring out in real time that the U.S. government is quasi-insolvent at 5% interest rates. They're in a bit of they're in a debt trap. They truly are trapped because the rates can't go higher because they wouldn't be able to afford the interest on their debt. Yet inflation is not yet under control. So they should be raising rates, but they can't. So you're going to have some form of yield curve control or money printing required to get them out of this mess. And that shift I mentioned earlier from the reserve currency US dollar losing a bit of its luster. I'm not here saying the US dollar is going to be replaced by another reserve currency. I'm saying you're going to see a rotation out of US treasuries, out of US dollars into gold, as investors realize they can be paid back with US dollars that are worth ever less money going forward. And by the way, Michael, this is not a US only problem. Canada's in an even worse position, unfortunately for us as Canadians. And the other European countries and Japan, they're all in the same boat. So that's a mega trend that's happening in real time, that real rates are going to have to be negative again very soon. And I think gold is sniffing that out. And a rotation out of fiat currency into hard currency, which is gold, is an enduring trend. In the stock market, the equities have not even at all woken up to this. So the gold market's waking up to this. Maybe some macro investors are waking up to this. Central banks are definitely waking up to this. But equity investors are not at all engaged in the sector. I mean, you saw Newmont's having a good day today, but Newmont's much closer to a 52-week low than it is to 52-week high. Most gold stocks are still well down from their 52-week highs. So we see a lot of room left for equities to start outperforming the overall market and the gold and precious metal space. And that macro trend, I think, is a real good tailwind for the years ahead.
Michael, thanks for speaking with Kitco.
Thank you, Michael. Good to see you again.
My name is Michael McRae, and you're watching Kitco Mining.